Guys, how are you doing? I hope all of you are doing well. Today, a little bit, I am not very well today. Okay, but I just wanted to do this marathon so that we can do a few kit questions. Okay, and we have looked at the textbook, we've looked at certain topics from the textbook. We also, in the last class, looked at hedging, if you recollect. Right, all these topics in the first marathon I had done. And then we came down and did hedging in the next class, in the previous class. Okay, hedging or payment. Test your understanding 1, chapter 15. Test your understanding 3. Test your understanding 5, which was part of interest rate risk and exchange rate risk. Okay. Subanjo, aren't you from FM? Olu, Wadalu. I'm sorry, I'm not able to pronounce, but Subanju, you're from PM, right? Okay, you're also doing FM. That's great. So again, in the previous two marathons, we had looked majorly on the textbook, and whatever topics you asked me from the textbook to do, I looked at those topics. Now, today, I'm going to solve exam kit questions. Okay, so that you get a sense of how to solve kit questions. So let's get started. Always remember, first read the requirement, then only the information. So this is question number 272 from the Kaplan kit. And we're looking at the annual holding and ordering cost of Dustyco's current inventory management system. Annual holding cost and ordering cost of Dustyco's system, right? So holding cost and valuation, holding cost and ordering cost, how do you calculate? Let's read the information. Dustyco purchases 1,500,000 units of component K each year. Okay. And consumes the component at a constant rate. The purchase price is 14 per unit. The company places 12 orders each year. So that should give you how much do you order at a, how many units do you order at a time? How many units do you order at a time? So how do we look at this? Give me 1 second. Yes, sorry, I had gotten a little bit of a call. Anyway, let's continue. We were looking at what? We were looking at the order side, the number of quantities ordered, or the demand is how much. The demand is 1,500,000. Okay. At a time you are ordering, how many you need to figure out. How will you figure that out? In a year, you are placing 12 orders. So number of orders is 12, right? So it's like saying, okay, I want 5 tables and I will order how many? Okay, so I want 6 tables, be even better. The calculation will be easier. I want 6 tables and I place how many orders? I place 3 orders. Meaning at a time, how many tables will I place an order for? 6 divided by 3, which is 2. Using this logic, I can find out how much do I order at a time. Each current order orders how many units? 1,500,000 tables I need. At a time, I will place, sorry, I'm making 12 orders over the year. So at a time, I place how many orders? Who can tell me this fast? 125,000. 1,500,000 divided by 12. 1,500,000 divided by 12 is 125,000. So this is how much I'm ordering each time per order. I'm ordering 125 units per order. Now, think about it. If I am ordering 1,25,000 units each time, at one point of time, I have 0 units, but then I buy 1,25,000. Then again, gradually the units will get over. Then again, I will get 1,25,000 units. Then again, gradually the units will get sold. Basically, they'll come back to 0. Then again, I will get 1,25,000 units. So on average, the number of units that I have is, at one time I have 1,25,000. At another time, I have 0 units. So on average, the average number of units I have with me is how much? Average number of units, average inventory is going to be, at one point I have 1,25,000 plus 0, because 1,25,000, 0, 1,25,000, 0, 1,25,000, 0. So on average, 1,25,000 plus 0 is 1,25,000. And there are 2 readings. What are the 2 readings? At one time I'll have 1,25,000, at one time I have 0. So there are 2 readings. So on average, the average inventory is 1,25,000 divided by 2, which is 62,500 units. And the question clearly says that there is a holding cost. The question, okay, I'll do that. The question clearly says that the holding cost of the component is $0.21 per unit. All of you at this stage know what is holding cost, right? So on average, I'm holding 62,500 units and I will incur a cost to hold that inventory. Maybe I have to pay for the warehouse. Maybe I have to pay for the staff to take care of the inventory. So the holding cost is how much? The holding cost is going to be, I'm holding on average 62,500 units. Each unit, there is a holding cost of $0.21 per unit. So it is very good, Trisha. 13,000 125 per year. So the holding cost is $13,125. Now that we have seen that, what happens? Think about it. The ordering cost of component is $252 per order. And how many orders are we making? 12. So our ordering cost as of now is 252 per order. I am making 12 orders in a year. So 252 into 12. Trisha again, or Sobanjo, anybody? 3024. Very good. 3024. Right? So what happens if it is 3024? The ordering cost is 3024. If we are to move ahead, if we are to move on, if you are, again, think about it, for the entire inventory, the inventory cost will be the holding cost plus the ordering cost. So the cost will be how much? It will be 13,125 is the holding cost. Ordering cost is 3,024. So the total cost is related to inventory is 13,125 plus 3,024. 13,125 plus 3,024 is, let's see. Trisha, I will come to that. It's how much? 13,125 plus 3,024 is 16,149. Remember, when I say this is the total cost, this is the cost of holding, this is the cost related to inventory management, that is holding and ordering. This does not include the cost of the inventory itself. Each unit is $14. Each unit costs $14. Here, I did not take that into consideration. Remember this, please. Right? Here, I'm only talking about the cost that is incurred to manage the inventory, to keep the inventory. Okay, so 16,149 per year is the cost. Calculate the annual holding and ordering cost of Dusty Co's current inventory management system. So whatever we've done here, Trisha, we've scored only 1 mark. How can we know, sir, how can we know that we have when to add the purchase cost and when not to? Is the question will tell you. Read the question. The question simply wants to know the holding cost and the ordering cost. They are not asking you for the total cost of the inventory itself. Right? So I hope I have answered your question there, Trisha. So far, we've looked at scoring, we've looked at how to score that 1 mark. Now we're moving ahead to the next 4 marks. How do we score the next 4 marks? Calculate the financial effect of adopting the EOQ as the basis for ordering. Now, Dusty Co wishes to investigate whether basing ordering of component K on the economic order quantity will reduce cost. So what you want to do is to find the EOQ. And we all know the formula of EOQ. It is root 2 COD by CH. Yes, you can, but it's a waste of time. If it's asking you as of now, the holding cost and the ordering cost, just focus on that. You will get the answer. But why do you want to spend time on that when it's not asked? Please remember, in the exam, you will answer only what has been asked, because when you answer things that haven't been asked, of course, it does not, the examiner just doesn't say, oh, this guy has, or this girl has answered what I didn't ask also, so let me give more marks. That does not happen. On the flip side, however, what can happen is that because you are wasting and spending time on areas where you are wasting time, spending time on areas that you don't need to spend time on, the danger is that you will not have time to do things that will actually get you marks. So please don't do that. Don't try that in the exam. Stick to what has been asked. So the EOQ is what? Root 2 COD by CH. So you need to just know what is CO. Do I know the CO? CO is the ordering cost. Yes, I know the CO. CO is 252. D is what? D is the annual demand. And I told you what the demand is, 1,500,000. This is again working capital management, guys. 1,500,000. COD by CH. CH is the holding cost. How much is the holding cost? Again, remember, CH when you do, you are talking about the holding cost per unit. And the holding cost is 0.21. Which is, so you're looking at the root of COD by CH. Who can put this and get the answer? 2 into COD is 1,500,000 divided by H. H is 0.21. You take the root of this. Again, I'm not able to put that sign here, but who can tell me the answer? How much is the EOQ? Trisha, you're right. It's 60,000. The EOQ. Anu, there must be a calculation mistake. Please try it again. Root 2 COD by CH. Can you try again, Anu, and confirm if it's 60,000? I'm going by what Trisha and Sobanjo are saying. The EOQ is 60,000 units, meaning, Anu, that it is best to order 60,000 units at a time. Anu, can you confirm? Is it 60,000? Yes. So it's 60,000, but as of now, I'm ordering 25,000 at a time. Remember, because as of now, I am ordering more units at a time, the number of orders will be lower and hence the ordering cost is lower. I've purposely given a pause there. I want that to sink in. As of now, we're ordering 125,000 per order. So we are ordering more at a time. And because we are ordering more at a time, we don't need to place so many orders. In a year, I will only place 12 orders. Because I'm only placing 12 orders, my ordering cost as of now is low. But if I go with the EOQ, which is 60,000 units at a time, I am ordering fewer units at a time. And if I order fewer units at a time, I will need to make more orders. The logic behind that is two scenarios. I should not be explaining at this level right now, but still, again, for me, I have a little bit of teaching OCD. Until and unless I'm not sure that I've given an example, I really cannot proceed. Right? In scenario 1, I order 5,000 pieces and I need 15,000 pieces total. Okay, no, not 15, 20,000 pieces totally. Because I am ordering 5,000 pieces at a time, I will make only 4 orders. Why? Because 20,000 is what I need divided by 5,000. So I'll only make 4 orders because I'm ordering more at a time. Switch that scenario slightly. I order 500 pieces at a time and I need 20,000 totally. In this case, because I'm ordering fewer at a time, I will have to order more number of times. So I will, in this case, make 40 orders. And therefore, my ordering cost will be high. That's exactly what is happening here as well. Earlier, we were ordering more at a time. So the number of orders were lower. Because the number of orders was lower, the ordering cost was lower. But now, with this EOQ in place, we're placing fewer orders at a time. Sorry, we're not placing fewer orders at a time. We're buying fewer units at a time. Because we're buying fewer units at a time, we will have to place more orders. Can everybody say, if you've understood this part, the number of orders will increase? Yes, just type yes. Last time the number of orders were only 12. But this time the number of orders will increase. Del, can you also confirm if you've understood this? 1,500,000. At a time, I'm placing 60,000 units order. So how many orders will I place? 1,500,000 divided by 60,000, which is how much? Ordering cost will be 25 orders. And think about it. I mentioned this. If number of orders is increasing, ordering cost will also increase. Think about it. I'm making 25 orders. Each order, there's an ordering cost of 252. So 252 into 25. How much is 252 into 25? Who can tell me? Sobanjo? 6,300. Very good. So the ordering cost, as you can see, Sobanjo, last time it was only 3,024, or rather presently it is only 3,024. But with the EOQ, the ordering cost has increased. So one might argue, if the ordering cost is increasing with the EOQ, how is it the EOQ, or how is it economical for us? Any guesses? Economic order quantity is that quantity where the cost is lowest. But unfortunately, what is happening here? Very good, Del. Yes, ordering cost is increasing, but the holding cost will go down because last time we were holding an average of 62,500 units. But this time the average inventory is only 60,000 we are holding. We are ordering 60,000 at a time. So it will be 60,000, 0. Then again, we will place the order, it will be 60,000. Then again, gradually it will get sold. So it is 60,000 plus 0, which is the same as 60,000 divided by 2. On average, at any given day, we're holding 30,000 units in the warehouse. And the holding cost is how much? As per the question, 30,000 into 0.21, which is how much? 12,600. I'm just going by what Trisha is saying. Is it 12,600? Doesn't look like. Yeah, exactly. I'm talking about the holding cost. 30 into 0.2. 30 into 0.2 should be 6,300. The holding cost is 6,300. You see, last time the holding cost was higher, but this time you've saved on the holding cost. So the holding cost has become lower. Therefore, the total cost related to inventory, as Trisha mentioned, yes, that is specifically in this question, right? The total cost related to inventory is 12,600. I'm putting this in black so that you're able to compare. Let me just see. Yes, we are recording. You're able to compare and see now. Last time, when you ordered 125,000 units at a time, your total cost related to inventory was 16,000. But now it is only 12,600. And believe it or not, you try any other order quantity except for 60,000. You try anything else, the cost will be more than 12,600. That is what makes 60,000 the most economical order quantity. Calculate the financial effect of adopting the EOQ as the basis. So we save money. So the financial effect is what? The financial effect is that we save about 4,000 rupees. Let me check the exact amount. So now, look, please don't leave the answer there. Anu, so we can use the EOQ. Yes, obviously. But please don't leave the answer here. You will only get 2 marks if you put this. You need to get back to the examiner with the answer. The examiner is asking what is the financial effect of going with the EOQ. So you will have to say this. You will have to say, yes, you should explain that. And so the saving by going with or by adopting the EOQ is how much? Before we were spending 16,149. Now we're spending only 12,600. So around, no, maybe not 4,000, about 3,000 something. How much is the saving? 16,149 minus 12,600. 3,459. Therefore, there is a saving of 3,549 by adopting the EOQ. Only if you put this, you will get full marks. If you leave the answer here, it does not answer the examiner's question, unfortunately. Although you've put the points, you've put the calculation, you will not get full mark. So one tip related to the exam is once you've done the calculation, you must close the answer. If they are asking for something like this, you must say what is the net effect. Please remember this because a lot of students do not do this. Is clear. So that we've gotten another 4 marks. So in the past 32 minutes, it's 4:32 Indian time. In the past 32 minutes, we've got now how many marks? 5 marks. Calculate the financial effect of accepting the bulk order discount. As of now, I don't even know there's a bulk order. See, don't aimlessly go and look for read the information. TECO a discount of 0.5% on the price of component K, provided the company orders 250,000 units per order. First and foremost, what is the implication? of ordering 250,000 units per order. Remember, for sure, the inventory management cost will increase. Why will the inventory management cost increase? Because remember, 60,000 is our EOQ. It is at 60,000 that the inventory management cost will be the lowest. If you're ordering 250,000 units per order, obviously you're holding on average 125,000 units in each. On average, you're holding 125,000. So think about it. What will happen to the holding cost? Holding cost will become huge. Why? Because on average, the average inventory will be how much? If you're ordering 250,000 each time, the average inventory will be 125,000. Therefore, the holding cost will be 125,000 into the holding cost per unit, which is 0.21. How much is it? Who can tell me? Is it 26,250? Yes. Holding cost is 26,250. You see, the holding cost itself by ordering 250,000 units, holding cost itself is higher than the total inventory management cost of EOQ. So definitely ordering 250,000 units at a time is a bad idea. It's a miserable idea. Because if I go with EOQ, my inventory management cost, including the ordering cost, is only 12,600. But if I go with 250,000 units per order, the holding cost alone will be 26,250. Forget the ordering cost. Ordering cost will be what? Think about it. The annual demand is, how many orders will I place? Will be, you need a total of 1,500,000. At a time, you are ordering 250,000. So 205. You will place 5 orders. Therefore, the ordering cost will be 252 into 5. Is it 1,260? 252. Sorry, how come ordering cost is how much? 5 orders, right? So 1,260. 252 into, guys, is my calculation correct? Yeah, it's 6 orders. Thanks, Subhanju. 252 into 6 is how much? 1,512 I'm getting. Therefore, the total inventory related cost will be 26,250 plus 1,520, which is 27,762. It is miserable. Why is it miserable? Why am I calling it miserable? Is because at EOQ, if I buy 60,000 units at a time, I will spend only 12,600. But by buying 250,000 units at a time, I am spending more than double. Trisha, I'll come to that. So it is a miserable idea to buy 250,000 units at a time. You are spending more than double unless you will save money elsewhere. And are you saving money elsewhere? Yes. The supplier is giving you a 0.5% discount. So what I will say is, by placing an order for 250,000 units at a time, we are spending way more than what we would spend at EOQ. It is not worth purchasing 250,000 units at a time unless there is a saving elsewhere. Here, there is a saving elsewhere. The supplier of the component has offered a 5%, not 5%, 0.5% discount. I'm just copy pasting that literally. Now our job is to see if this discount of 0.5% is worth it. You understand? So in this case, what is happening is definitely, I'll do the math here. I said placing an order for 250 at a time is not worth it. We're spending way more than what we would spend at EOQ. So I want to know how much extra are we spending. So that part I'm putting in purple. The increase in the total inventory management cost would be, by purchasing 250,000 units at a time, you're spending 27,762. And if you went with the EOQ, you will spend how much? 12,600. However, here there is an assumption. There is something tricky. Here we are going with the assumption of what is the excess over our present ordering quantity. Our present ordering quantity is how much? Our present ordering quantity, we are ordering how much? 125,000 per order. So as of now, our total inventory management cost is 16,149. And by ordering 250,000 units each time, you're spending how much? 27,762 minus 16,149. So you're spending in excess of how much? Everyone, charge is not enough. Sir, I'm leaving, but I like your class. Okay, charge is not enough. Please make sure you all sit with charge. This is the second person who told me in this meeting that they like my class, but they don't have battery, so they've requested me to record. Who is the first person? Somebody told me this. Okay, it was Anu itself, same person. Okay, Anu, please make sure you watch the recording. So the increase is how much? The increase, you're spending how much extra? Who can tell me? You're spending about 11,613 per year extra. I hope you all agree. Very good, Subhanju. 11,613. However, there is a discount. So we need to see which is more, the increase in the total inventory management cost or the saving because of the discount, which is more. Are you understanding? And based on that, we will make our decision. I hope everybody is clear. Right? Now, going back, Dustico has no cash but has access to short-term finance via an overdraft facility at an interest rate of 3%. This means what? This means by holding the inventory, what is happening? We need to see. First and foremost, again, when you go with the bulk order, you get a discount. How much discount are you getting? You're getting a 0.5% discount. And you will not get it only on the 250,000 units. You will get it on all the units. So you are getting a discount of 0.5%. Each unit as of now is 14. But when you get a 0.5% discount, there is a discount or there is a saving of how much? 1.5 million into 14 into 0.05 is how much? 0.5% discount. I'm sorry, let me check that calculation. 0.5 divided by 100 is how much? I think it'll be 0.005. Yes, it is 0.005. So who can do this calculation for me? 1.5 million into 14 into 0.005. I'm getting 105,000. So there's a saving of 105,000. So guys, you see, it is making a little sense now. I doubt Subanjo, it's not 1,050,000. The saving is 105,000. It is making some sense now to pay 11,613 extra and take a saving of 100,000. It's like you're paying 11,613 extra to get a saving of 1,05,000, which makes sense. I hope everybody is with me. I hope everybody is understanding. Right? Everybody clear? Trisha is back. Or Trisha, you were always there. Okay. So there is a saving, but in addition to that, what is happening? Has no cash but has access to short-term finance, meaning that in order to buy this 250,000, you need what? You will have an overdraft. This overdraft currently stands at $550,000. In this case, what? In this case, what happens? One second, guys. Just give me 1 second. So yes, coming back. At the same time, as of now, remember there is no cash. So you will need to borrow from the bank. Not borrow from the bank as a loan because there is no mention of a loan, but there is an overdraft. Remember, as of now, whatever inventory you are buying by overdrawing from the bank, and for that you have to pay 3% per year. As of now, As of now, what is happening? You have, as of now, on average, you have 125,000 units. Correct? As of now, you have 125,000 units. Sorry, I was looking at the wrong thing. You have, as of now, 62,500 units. So, on average, you are holding 62,500 units as of now. 62,500. And each unit, you pay how much? You pay $14 for each unit. How do I know this? The question is telling me this. So 62,500 into 14 is how much? $875,000. The value of the inventory right now. Today, Anu is back. Very good, Anu. 875,000. But if you go with this bulk order, the value of the inventory will jump. If you go with the bulk order, on average, you will have 125,000 units of inventory, and each unit will have a value of how much? 125,000. Each inventory will not have a value. Each unit will not have a value of $14. There is going to be a 0.5% discount. So it is like you're paying 99.5% of 14. How much is it? Because there is a 0 point, very good, Anu. Instead of 14, each unit you're only paying $13.9 because of the discount. Therefore, the value of the inventory will be how much? 125,000 into 13.93, which is 1,741,250. So how much is the extra value of inventory that you are holding? The extra, you are holding excess value of inventory. Excess value of inventory will be how much? Before you were holding only 875,000. But now you're holding 1,741,000. Anu, I'm going with your answer, okay? I've not done the calculation. 866,250. Meaning, because we are going with this bulk discount, we have an extra inventory. We are buying extra inventory worth 866,250, and we will have to pay an extra overdraft of 3% for this extra cost. Can I repeat myself? I am paying extra overdraft of 3% for this extra cost. Therefore, the excess overdraft expense will be 3% of 866,250. Anu, can you tell me how much is it? $25,988. So this is an extra cost. So you see what is happening here. There is an extra cost of 25,988 because I am going ahead with the, I'm putting it in light blue. Because I'm going ahead with the, I'm getting 25,988. Because I'm going ahead with the excess, I'm going ahead with ordering 250,000 units at a time. I have an excess overdraft or extra overdraft cost of 25,988. On top of that, I have an extra inventory management cost. Inventory management cost. How much is the extra inventory management cost? It is another 11,613. I'm putting that also in light blue. So you see there is extra cost 25,988 plus 11,613. Is it worth placing an order for 250,000 units? Doesn't look like. Why? Because there is an extra inventory management cost of 11,613 plus an extra overdraft cost of 25,988. So you're telling the supplier, I have to pay extra 11,613 plus another 25,988. I don't know if I should place the order for 250,000 units. He says, if you place the order for 250,000 units, I will give you a discount of 1,05,000. So you're getting a discount of 1,05,000, yes, out of which there is an extra expense of 25,988. And there is an extra expense of 11,613. So even if you add up the extra expenses, it is only 36,000 or 37,000. Saving is 1,05,000. I'm putting the saving in green and the extra expenses in red. You see, the saving is still more than the extra expenses. So it makes sense to go ahead and place the order for 250,000 units at a time. Why? Because there is a net saving of 1,05,000 minus 25,988 minus 11,613. There is a still very good, Subhanjo. There is a net saving of 67,399. Therefore, it is worth going ahead and placing the order for 250,000 units. Now, again, go back to the question. What is the financial effect of accepting the bulk order? You will say, by accepting the bulk order, our expenses go up by 25,988 for the bank overdraft and 11,613 for the incremental or extra inventory management cost. However, there is a massive saving of 1,05,000, because of which there is a net saving of 67,399 by adopting the bulk discount. Therefore, Dustyco should go ahead and place the order for 250,000 units. Once you put that, the examiner will clap and give you full marks. You need to explain also in 1 or 2 lines. So far, in the past 57 minutes, we've only looked at 1 plus 4 plus 4. 9 marks. Recommend with justification which option should be selected. I've already told that part. The justification part I've already explained. 10 marks we've got in the past 57 minutes. What was it? Yes, Dustyco should go ahead with placing the order for 250,000. The justification is that although there is an additional expense of 25,988 and 11,613, look here, there is an overall saving of 105,000. So there is a net saving of 67,399. Therefore, it makes sense for Dustyco to go ahead and place an order for 250,000 units per order and not go with the EOQ. So with that, we've got 10 marks in the past 48 minutes. The next part, which is 10 marks, is a discuss question, and this is where a lot of FM students lose marks. FM students believe, FM and PM, this happens very commonly, unfortunately. FM and PM students believe, okay, AA, it's completely theory. So what they do is they have no other choice but to write and explain. But in FM and PM, unfortunately, students focus on the numbers part, but don't pay a lot of attention whenever it's discussed. Where we need to spend some time, right? See, the question is this: how do you understand and how do you fund the working capital? What strategies do you use to fund the working capital? It's 5 o'clock. Here, when you answer a question like this, now again, this is done. Anu, I cannot explain. Okay, Anu is asking, I can't explain very wildly. Okay. So, how do you do this? Is this? Whenever you have funds, whenever you are using funds, okay, one strategy or one thing to keep in mind is that short-term funds and long-term funds have different costs involved. Short-term funds and long-term funds have different costs involved. For example, this. We all know that long-term funding is more expensive. If you're going for a bank loan, it's more expensive, right? This is one thing. This is one thing we need to take in mind. Keep in mind. One funding strategy, one factor that you need to keep in mind is the fact that short-term is what short-term debt is cheaper. Long-term debt is more expensive. You need to keep that in mind. Aggressive and okay, so Banjo is asking aggressive and conservative working capital funding strategy. Yes. Again, but again, we're talking about certain factors that you need to keep in mind. See, your strategy, yes, you have your strategy, which we can look at. But in addition to that, certain things that will kind of affect you. What do I mean by this? Here, you need to also take into account. We've looked at cost differences based on risk. What I mean by this is short-term debt is cheaper, right? Why? It's not much risky. I mean, I'll not lose much. You'll pay me fast. But the other element that you have to keep in mind is different funding policies have different benefits. So again, How do I put this? Different funding policies have different costs and benefits. Again, remember, we have what? Again, Dell, this is, these are part of, these are strategies. Which strategies will you use? How will you fund? Okay, let me remove this. You need to know that, okay, what is your strategy in terms of funding? What factors do you need to keep in mind? So please don't get confused. The question is simple. The question is, when you are to get funding, when you're using funds for working capital, what are certain things you need to keep in mind? You just ignore the strategy. Oh, difference between strategy, policy. Please avoid that. Question is crystal clear. Question is asking, with respect to funding working capital, what are certain things, what are certain factors that I must keep in mind? Simple, very easy. Del, are you there? So I will put this in one point for now. There is cost and risk of short-term and long-term finance, because as I told you, long-term finance from the company point of view, long-term finance from the company point of view is less riskier. Why is it less riskier for the company borrowing? Because I have 5 years, 7 years, 8 years, 10 years to repay the loan. Unlike a short-term working capital funding. In short-term working capital funding, like for example, a payable, like for example, a bank overdraft, whenever they call us and ask us to pay, we have to pay. So there is risks associated with short-term finance that may not be there in long-term finance. And also remember, different funding itself has certain costs and certain benefits. Another thing we need to keep in mind is we need to map, and the best word used in the textbook is match. Matching needs to be done. What I mean by matching needs to be done is, again, if I want to fund, say, current assets, if I want to fund current assets, I can use what? I can use short-term finance. I want immediate cash, for example. I can use a bank overdraft. But to buy a non-current asset like a car, using an overdraft is pathetic. You need to match short-term assets to short-term financing and long-term non-current assets to long-term funding. This is known as the matching principle. This is also something you need to bear in mind, keep in mind. Another way of funding, another funding strategy is that every person is different and every person's perception is different and their attitude towards risk is different. So I'm just putting this as others. I'll explain that, but others in general. Now that we have this, okay, so Anu, you were asking for this, where, what do we have? You said you don't know how to elaborate. So what I've done is I haven't elaborated on anything. All I've done is just put some points. Now I will elaborate on those points. So it becomes kind of, you know what it is, and you're just kind of elaborating on that. So if I have to, for example, talk about cost and risk of short term, the first one, short term and long term finance. So I will say this. I will say, again, I put it in points. Normally, longer term debt is more expensive than short term debt. Due to liquidity preference. This is directly there in the textbook. Right? However, so you see, cost wise, long term debt is more expensive, but risk wise, short term debt is more risky. Why? Because overdraft would have to be paid upon demand. So you see, even those points I'm further putting cost. I have elaborated and said long term debt is more expensive than short term debt. I've mentioned that to the examiner. I've communicated this. Then I've talked about the risk. I said short term debt is more risky. So in both cases, I've mentioned the point and then I've told the reason. That is, in the first point, I said I talked about the cost. So when I talked about the cost, I said which one is more expensive and I gave the reason. Then I'm talking about the risk. Second thing is risk. I briefly mentioned that short term debt is more risky and I gave the reason. This is what will get you full marks, Anu. So you've mentioned the heading, you've put the heading, Anu Gar, are you Anu? I know it sounds a little silly to ask like this, but are you the same person? Okay, not the same person. So you see, this is how we are answering. This is how we get full marks. I've told cost, I've told which is more expensive with the reason. Risk, I've told which is more risky with the reason. So you know now, the examiner knows now that you are in a position, you know the information. Once you know this, you put this in the form of a paragraph. What do I mean by put this in the form of a paragraph? You will just say long-term debt is more expensive than short-term debt due to liquidity preference and default risk. Long-term debt, you don't put it this way, examiner will not be happy. This, I've just done it for you. Long-term debt is more expensive due to than short-term debt. You see how I'm filling the blanks? Due to liquidity preference and default risk. Obviously, longer I have to wait, the more the chances of that debt turning bad. However, in terms of risk, short-term debt, even though it is cost-wise lower, it is more risky. Just join. Short-term debt is cheaper as compared to long-term debt, but is more risky. Again, remove this dash and give examples, elaborate on that. Overdraft would need to be paid on demand. And short-term loans, because there would be more terms on you. There would be terms and conditions applied on you would be more, making a short-term loan not very desirable. Anyway, you don't need to worry about that too much. But you see how I've put those 2 points in the form of one sentence. Long-term debt is more expensive than short-term debt due to liquidity preference and default risk. Short-term debt is, however, cheaper as compared to long-term debt. However, short-term debt is more risky. The reason it is more risky could be, one reason it could be more risky could be an example of a short-term debt is an overdraft. Short-term finance is an overdraft. Could be overdraft would have to be paid on demand. Now read this. You yourself will give yourself full marks. I know you were talking about the fact that you're not able to put these points in the form of a paragraph. You're not able to widely answer. But I've step by step given steps as to how to arrive to an answer like this. Step by step, literally. So now you read the answer. Long-term debt is more expensive than short-term debt due to liquidity preference and default risk. Short-term debt is cheaper as compared to longer-term debt. However, short-term debt is more risky. One reason it could be risky could be over this. If you put, you will get full marks. Just have a read of that. Next, I will explain to you the matching principle. Again, when we put our answer here, what did I say? You've put your points. Once you put your points, you have to elaborate on each point. Here, we said the cost. So in first step, I said, okay, mention what is the cost. Okay, anyway, I've explained that. Here, one point you've given is the matching principle. So you need to briefly in points elaborate what is this matching principle. This states that as per this principle, the maturity of the assets should be reflected in the maturity of the finance itself. As I said, after you've just elaborated on that point briefly, the examiner does not understand this. You need to give an example after that. For example, Don't just leave it at what it is, because the examiner doesn't know. He wants to know from you, what do you mean by that? For example, in order to fund non-current assets, we will use long-term finance, not short-term finance. For example, we must use long-term finance for non-current assets, because non-current assets are long-term assets. So you see, you are matching long-term finance with long-term assets. You remember match the following in school. So you have long-term finance, you have short-term finance, you have long-term or non-current assets, and you have current assets. So you match the following. What do I mean by match the following? Again, matching principle says for non-current assets, we use long-term finance. That's what I have told here. We must use long-term finance for non-current assets, for permanent assets. And for fluctuating current assets, we use short-term finance. This is the matching principle. I'm literally doing match the following. And this I have elaborated in this point. So Anu, when I answer this question, I mention matching principle. The first line I open by briefly mentioning what is the matching principle. Then I elaborate on that further by explaining to the examiner an example of the matching principle and how do I match. Now what you can do is, now that you have these points, you can put it in one answer, you can put it in one point, and you can say that as per the matching principle, the maturity of the asset should be reflected in the maturity of the type of finance used for them. For example, we use long-term finance for non-current assets. And then you can add and say for short-term assets, that is for current assets, for fluctuating current assets, we use which finance? Short-term finance. Now you see, Anu, you have the answer. As you said, wide coverage, where you're not only saying what the matching principle is, but you're also elaborating it to the examiner as one of the factors that you need to keep in mind. Yes, you can also write about aggressive and conservative. Technically, that's why I've left this cost and benefit of different funding policies, because that, remember, funding policies, when we talk about, we're talking about, again, that some people follow an aggressive policy, conservative policy. That's why I've purposely left this over here, because already two of you have talked about it. So that's where you elaborate here. Sorry, that's what you elaborate over here. How would an aggressive guy be with respect to finance? Then we talked about some other key factors. So here you need to talk about things like management attitudes to risk. Apart from this, what else? Again, Anu. Again, how do I do this? Apart from management attitude, the size of the organization, how big the company is. Yes, Subhanjo, right? What I mean by this is the overall organization itself will affect the strategies used. The organization itself affects the strategies used for working capital funding. Because again, I'll elaborate on that later. But remember, Anu, when you're answering, just put the point. I've said management attitude to risk affects the funding strategy. Correct? So now you have to elaborate on that. For example, a risk seeking management team would go for or would not mind an aggressive working capital funding policy. For example, somebody who is a risk taker but risk averse, some management that does not like risk, would go conservative. So, Anu, again, you put what it is. Put what it is means say that the attitude towards risk is different from company to company to a great extent, depending on the management. This is the fact. Anu, you agree with me? So you first put the fact. After you put the fact, you give an example. Then you join that and you say, you put that as one big, beautiful answer. Then again, similarly, organization itself, you can put an opening sentence and say, the nature, size, structure of the organization greatly vary. We know this. It's an opening sentence. Now again, put an example. The size of the organization would greatly affect the accessibility to funds. Like a big organization would have better access to funds. Do you agree with me, Anu? So a bigger organization Apologies, I got disconnected. Right? So I hope all of you are clear. With again, you know the answer. By now, it's surprising if you don't know what to put. But here I've just given some tips and tricks as to how to impress the examiner. Again, an example is you first mentioned the cost and then you talked about the risk. You said which type of funding is more expensive and which is less expensive. And then you supported it with a reason. Then you talked about risk. You said which type of funding is more riskier compared to the other one. And then again, you supported that with a reason or an example. When you close your answers like this, you will get full marks. But ideally, because this question is 10 marks, you will not stop with just 4 points. Here I have given 4 points. This, this, and this. Ideally, there are 10 marks, so another point, a fifth point, will be required to close your answer with full 10 out of 10 marks. But again, here I've given you tips as to how to answer, and in each point, how do you get better marks? I hope how to answer this type of a question has been helpful. Subanjo and Del, Anu and Trisha, can you share your comments? Yes, Sobanjo, 5 points is more than sufficient. More than sufficient. But please know, please realize that just putting these 5 points and not elaborating on them as the examiner that's why my entire focus hasn't been on putting the points, because I know points you will put. Everybody at this stage, you hardly have the exam next week. So again, as I said, it's surprising if you don't know the points. Points you will put. Putting the points is not where people lose marks. The reason why people who fail is because they don't know how to impress the examiner. So I've given you some tips and tricks for that. Implement those tips and tricks. Okay, so we've looked at this question. Now I'm just, again, guys, if you have any difficult questions which you don't know how to practice, you don't know from the exam kit, you can definitely share it with me privately, personally, and I will try to come back to you. There's an NPV question. Can we do it or shall we ignore it? If NPV is easy for you, you can ignore it. It's a 20-mark question. DISCSA. What do you want me to do now? Let's do it. Okay. Do it, sir. Okay, fine. Let's move ahead. Okay. Again, please remember, we are to always read the question first. Trisha, you're having internet issues, is it? Why are you joining, leaving? Anu at least mentioned that there is charge issues and there's no electricity. Sometimes I myself am in a situation like that, so it's understandable. Trisha, are you understanding what I'm saying, or because ultimately it has to help you? Network issues, okay. So calculate the NPV of the investment project and comment on its financial acceptability. So let's look at it straight away. Well, if you see, there is a project, right? And let me just try to identify the core important pieces of information. Initial investment net present value by 800 to meet increased demand. The expansion will cost 3.2 million. The selling price of the unit is 3.1 and variable costs are 1.1. Selling price inflation of 3% per year and variable cost inflation of 6%. Nominal fixed costs of production have been forecast. ACCA has a nominal after-tax weighted average cost of capital of 10%. And so you see, this question has everything, including inflation that we saw, I think, in the 6th or 7th chapter of the textbook. The company can claim 25% reducing balance tax allowable depreciation on the full cost of the expense, which you should assume is paid at the start of the year. Evaluates all investment projects as though they have a project life of 4 years and assumes zero scrap value. DISCSA has limited capital investment. So they've also included what? Capital rationing involved in this question because capital availability of funds is limited. And requirement of funds is 3 plus 2 plus 1 plus 1 plus 2. 3 plus 2, 6, 6 plus 1, 7, 7 plus 1, 8, 8 plus 2, 10. The requirement for funds is 10 million, but the availability of funds is only 7 million. Although I don't need this piece of information for part A of the question, I'm just highlighting this to you. Oh, yes, see, there is capital rationing. So there is capital rationing here. You have a shortage of funds. The division has identified 5 possible investment projects as follows. Now, projects C and E are mutually exclusive projects. So let's get at it, okay? Again, there is a lot of calculation involved in this question. See, you are selling for how much? Your revenue is 3.1 per unit and your revenue is 3.1 per unit. There is an issue with my Excel, unfortunately. I would love to normally do this on Excel, but there has been an issue. So I'm just putting the explanation. I'm just showing you how to do it. For now, at least. So revenue is 3.1 million. Right? Now, the question says what? Selling price inflation of 3% per year is there. So again, if the selling price is 3 now, in the first year, the selling price will be inflated by 3%, which is 0.03 of 3.1. How much is 0.03 into 3.1? 3% of 3.1. Who can tell me? Guys, we will have to go faster, and we will go faster if you're sitting with calculators. 0.093. So 0.093 plus 3.1. How much will be the new selling price for the first year, Trisha? Okay, I will do this because again, otherwise we won't finish. 3.1 plus 0.093. 3.193. So the selling price after a year will no longer be 3.1. The selling price, because of the inflation, will become 3.193. And how many units am I selling? So the selling price per unit will be 3.193. As of now, the selling price is 3.1. The number of units that we are planning to sell, again, look at the first line, is looking to expand capacity of an existing factory in its alpha division by 850,000. So the number of units sold will be 850,000. So 3.193 into 850,000. How much will be the sales or the revenue in a year's time? 850 into 3.193. I'm getting 271,000, 4,000. No, sorry. 27. Again, my calculator is like, it's Indian. So there's a little bit of a, there is a little bit of 271,4050. So how much is that? 27, 2,714,050. 2,714,050. So you have the revenue. Similarly, we calculate the revenue for all the other years. So I would request, because of the shortage of time, I would request that you take the next 2 minutes, all of you, go to the answer of question number 282 and check if you understand the revenue for year 2, 3, 4, and 5. The logic will stay the same. Let me know if there's a problem in arriving at the revenues individually, because the concept is the same. And again, if I have to mentally do all the calculations, it will take a lot of time. So I'll give you 2 minutes, review it, please. Go to the answer and check if you're happy with the individual revenues. Come back. So again, I hope all of you have gotten the answer. So with that, we will have the revenues that I expect in year 1, year 2, year 3, and year 4. And again, I will go down to the answer, and I'm as of now just going to copy paste, because in for the first year, I've already told you how to get the revenue. Same way I'm getting the revenue in the second, third, and fourth year. So I'm just going to the answer. Just give me a minute. I'm just scrolling. Once I get the answer, this part I'll copy paste. Anybody has an issue with this much? Also, I would love to know what is the status of your preparation. Like all of you, textbook, kit, Kaplan kit, all this is done. Guys, any problems, you can reach out to me. In fact, I would have loved to handle the entire FM batch for you, because at least in terms of, I am very confident that, okay, now past is past. We can't do anything much about it. But to a great extent, the students have benefited from me. So you can always reach out to me, message me privately. We can discuss your preparation, what situation you are in, where are you standing. I can guide you. because I have actually helped thousands of students clear their exams by now. And I don't know if you've understood my teaching style yet, but I generally prefer, okay, I've got the answer. So it's 2 million. So let me complete what I was saying. I generally prefer giving some examples and analogies and making sure the concepts are very crystal clear for you. So any problem conceptually, reach out to me, I will help you. Okay. But anyway, I've reached the answer. I was just scrolling. So I got revenue for year one is 2,712,000. Year two, I got 2,797,000. Year three, I got 2,882,000. And year four, I got 2,967,000. Okay, so each of the 4 years, this is the revenues that I have got. How can you get my WhatsApp? So I normally put my name and my number at the beginning of all the classes. So whoever wants to reach out to me can message me on WhatsApp on this number. Okay. So similarly, you will now that you have the revenues, you will calculate the variable costs also for year 1, 2, 3, 4. How is the variable cost is given to you at $1.1, but remember, with respect to the variable cost also, the variable cost will inflate by 6% per year. So in year one, variable cost will be 1.1 plus 6% of 1.1. Into how many units are you making? You're making 850 units. So same way you will get the variable cost also. So I'm just directly moving to the answer because all of this is like basic math, basic calculations. So similarly, same way, just like how you get the selling price, you get the variable cost. Dusty we did. $282. You see, variable cost was 1.1 plus there's a 6% inflation. So it becomes 1.17 and there are 850,000 units. How do I know 850,000 units? Is because in the first line of the question, it was mentioned. You can, if you don't believe me, do this. 1.17 into 850,000 will be 995,000. So the variable cost is 995,000. So the revenue for year one is 2,712,000. Variable cost is 995,000 for the first year. This has been mentioned here. See, revenue is 217,000, 2,712,000, and variable cost is 995,000. And you all by now should know at least from PM. How many of you are yet to do PM? All of you completed PM? Anu, Bhavya, Del, Sobanjo. PM, Sobanjo, PM not yet done. Okay. What about others? From PM, I'm sure, Sobanjo, you would have done your MA, right? And you know that selling price minus variable cost is not the profit, but it's the contribution. You're familiar with this, Sobanjo? From that contribution minus fixed cost is the profit. So fixed cost, as per the question, Fixed cost is, okay, I don't know what is a fixed cost. Where is a mention of fixed cost? Fixed cost. So I simply subtract it. Nothing else needs to be done. Simply from the contribution of year 1, 2, 3, 4, just subtract the fixed cost. It's just there in the question. If you subtract fixed cost from the contribution, you will get the profit. However, read this. Has a nominal after-tax weighted average cost of capital of 10% and pays corporate tax of 20%. And the company can claim 25% reducing balance tax allowable depreciation. So you've seen that information, 25% reducing balance tax allowable depreciation, and we pay taxes of 20%. So again, because it's all repetitive calculation, I'm going back down. You see, from the variable cost, you've got the selling price or the revenue, you've got the variable cost, you've got the contribution, selling price minus variable cost, you've got the contribution. From that, all you are doing is deducting the fixed cost to get the taxable cash flows. Now, the taxes are paid 1 year in arrears. What do I mean by 1 year in arrears? This also you would have learned. Okay, you don't need to do the tax paper to do this, but tax is 20%. And it's paid 1 year in arrears, meaning first year's tax you pay in the second year. Second year's tax you pay in the third year. Third year's tax you pay in the fourth year, and fourth year's tax you pay in the fifth year. And that's why it is shown 1 year later. I hope everybody is understanding this. Just have a look. Then comes tax allowable, the benefits, tax benefits. Again, the tax allowable depreciation in year 1 is 800,000. Okay. How do I know this? Guys, apologies. I'm going back again. I just want to know 800,000. Okay. So you see what has happened is this. You have what? You have this asset. How much are you investing on this asset? Think about it. How much is the tax allowable depreciation? First of all, we're doing reducing balance method. So the depreciation is reducing balance, right? And the expansion is costing 3.2 million. So the investment is 3.2 million, and that will depreciate by 25%, reducing balance. So again, this goes back to the basics. Unfortunately, this question is a very easy question. 3.2 million is the cost. First year's depreciation will be 25% of 3.2 million. 25% of 3.2 million is 800,000. That's how we got the depreciation for the first year. First year depreciation is 25% of 3.2 million, which is 800,000. Second year's depreciation is what? It's a reducing balance, right? So second year, the carrying amount of the asset will be how much? From 3.2 million already, 800,000 is depreciated. So there will be a depreciation of about 600,000. Why? Is because the carrying amount will be 3.2 million minus 800,000, which is 2.4 million. And there is a depreciation of 30% of that, which is 600,000. So the depreciation for the second year is 600,000. Then the carrying amount will be, let me make it simple here. First year, from 3.2 million, there was a 30% depreciation, which is 800,000. Then from that 800,000, only 2.4 million was remaining. And there was a depreciation of 30%. So the second year depreciation is 600,000. All of you understood how did I get the depreciation for the first and second year? Please tell me yes or no. Did you all understand how did I get the depreciation for the first year and the second year? What about Sobanjo? What about Bhavya? So you see, what happens is you've got the individual depreciations, tax allowable depreciation. Now there is a tax of 20%. And okay, there is taxable profit, all of that is there. But again, tax allowable depreciation is here. And the tax benefit is that what? The question says that you have tax allowable depreciation, meaning that you don't need to pay tax on that depreciation, and tax is 20%. So you don't need to pay 20% of 800,000 because of depreciation. Because there is depreciation of 800,000, when you pay tax, it's like, oh, you are crying. You are unhappy that there is depreciation of 800,000. So the government comes and tells you, no need to pay tax on this 800,000. So you get a saving. And that's why it's called tax benefit. You save 20% taxes. So tax allowable benefits are here. Okay, so you finally get the after tax cash flows for each of the years. And now you know how much profit do you expect in year one, two, three, four, five. Fifth year is not there, but still there is a cash flow in the fifth year. After this, you will just use the discount factor table as usual. 10% for 1 year, discount factor is 0.909. Multiply the future value. Future value is 1,607,000. Present value is equal to, you need to know this. This is chapter 1 to 4. Future value into the discount factor. Future value, the value after 1 year is 1,607,000. So the future value is 1,607,000. The discount factor is 0.909. Therefore, 1,607,000 into 0.909 is 1.461 million. Similarly, you get the present values for all of the other years. And you get the net present value using that. So the present value of all the future cash flows, if you add this up, 1.4, 2.5, 3.4, 2.5. Yeah, it'll be I'm just seeing if it adds up properly. It makes sense. It'll be about 4,383,000. And the initial investment now, present value, the cash flow that is going out now is 3,200,000. Therefore, the NPV is 1,183,000. If you go back to the question, you've got the NPV. You've got the NPV. However, go back to the question and see if you've answered always, all the time, in FM especially. Go back to the question and see if you have answered the question in full. Calculate the net present value of the investment project. But that is not the only question. They're also asking you to comment on its financial acceptability. So if you are only calculating the answer, you will not get full marks. You will need to comment. And as far as I recollect, it was a positive NPV project, meaning that the project is financially acceptable to which company? Disxa. So you have to mention the company name. You say, since the project is having a positive NPV, it is financially acceptable for Disxa. Guys, is this clear? Any doubts with part A of the question? So far I've answered questions worth 28 marks. Guys, any issues with part A? Bhavya, you understood? Del, you understood? Guys, again, due to the shortage of time, there's only limited amount of things we have covered, we could cover. But I wish you the very best. Yes, the recording will be uploaded for the exam. And again, as I mentioned, due to a shortage of time, there's only so much we can do. But whoever wants to privately reach out to me, wants guidance, can by all means reach out to me on this number. I will, as much as possible, try to help you. Okay. So I wish you the very best for the coming FM exam and for your exams after FM, that is for the September sitting. Okay, Bhavya, you can reach out to me individually. I can give you some tips and tricks, strategies on what to do, what can be done, depending on your situation, depending on what you've done. Giving last minute strategies generally doesn't make sense because everybody comes from a different place of preparation. So I don't normally do that unless I know exactly where you are. Then individually I can give you, okay, this given your situation, you do this. Suppose you tell me you've done Kaplan, you've completed it. I will tell you, okay, what about Study Hub practice questions? In that, if you haven't even started, I'll tell you a few specific questions to start. So it really depends on you individually. So please message me and I can help you individually. Okay, Dell also, you can reach out at any point of time. This is my contact number. Reach out and wherever possible, we will try to help you. Okay, guys, so I will stop this recording now. Reach out wherever possible, we will try to help you.